The government's latest federal budget did not change the stage 3 tax cuts. If you've been following these tax cuts in the news, you know this has been a political football. There is a lot of talk about giving the medium and high income earners more tax breaks. There has also been a lot of talk about scrapping the tax cuts or changing how it's being implemented. Everyone knows that inflation is high at the moment, so is the cost of living. There's also record state and federal debt levels post the 2020 lockdowns as well. But it is looking like it's going to commence for the stage 3 tax cuts in July 1 of 2024. And if there was any change that's going to happen, it was most likely going to be changing in the last government budget, which did not occur. This is where you need to pay attention. Everyone is tired from working all year and ready for the Christmas break. I get it. Everyone's tuning out. Everyone's going for their Christmas holidays. But these changes could impact you heavily, okay? And if you stay in front of it, it could seriously change how you structure your finances. I want to deep dive into these stage 3 tax cuts and how this will impact you and building your wealth. So if you're interested, definitely keep watching. My name is Adrian Player. I'm a mortgage broker based up in Brisbane, and we're in the investment property space. Investors are pretty much every one of our clients. We do the finance side as well as the buyer's agency for clients that want to build wealth through property. So it's good that we stay on top of the current news and affairs. So if you're interested, definitely keep watching, and let's go straight into the article. So the article's here. So in the budget, the government did not announce any personal tax rate changes. The stage 3 tax changes commence on July 1, like we talked about, as previously legislated. Now, if everyone wants to have a look at the current brackets, and then let's talk about this topic. What is bracket creep? So bracket creep occurs when income rises due to inflation, wage growth and promotions, pushing most individuals into higher tax brackets overall. Okay, so the government needs to keep on, it's called bracket creep. So over time, they're constantly being pushed up into the higher brackets, which is why the government needs to do these kind of changes. All right, so when we look at these changes, here's the current brackets. If you want to have a look at that or stop it on the screen, then we need to talk about what's being rolled out in 2024 and 2025. So if you look at the highlighted section here, these are the main changes. So from July 1, 2024, the 32.5% marginal tax rate will be cut to 30% for one big tax bracket between 45,000 income and 200,000 income. So everyone knows that it's a system that the first $18,200 that you earn, you have no tax. And then every dollar from that to 45,000, you have 19% taxed of the money above 18,200 to 45,000. That's how our tax system works. So right now, these two brackets are the main two that are affected going forward, and this bracket here is the one that's creeping upwards. All right, so let's read it out. So the 32.5% marginal tax rate will be cut to 30% for one big tax bracket between 45,000 and 200,000. This will more closely align the middle tax bracket of the personal income tax system with corporate tax rates. The 37% bracket will be entirely abolished. Okay, then let's go through the example that they've given. So there will only be 3 personal income tax rates, 19, 30 and 45% from July 1. So taxpayers earning between 45,000 and 200,000 will face a marginal tax rate of 30%. With these changes, around 94% of Australian taxpayers are projected to face a marginal tax rate of 30% or less. So let's talk about me personally and what I'm doing. And I just want to be very clear that when we're talking about these kind of things, we've always got to be using an accountant and getting the advice from the accountant. So I'm going to give you a personal example of what I'm doing, and then everything's run through an accountant. Do not take this as financial advice. Always go back to your accountant. Okay, and always get a good tax accountant that knows what can or can't be done, and always take their advice. So right now I've got a company, right? And the company tax rate used to be 30%. Then it went down to 27.5%. Now it's at 25%. So there's a lot of different things that you can do when you've got a company. All right, you can have your spouse work under the company, so you can split the income up between you and myself, as long as your wife or your partner is working in the business, which is something that Maria and I are doing at the moment. Okay, you've also got other things that you can do. You can have a bucket company, which is essentially any profits that we make on a yearly basis, we can keep inside the company as retained earnings and get the company tax rate and sit that money inside of the bucket company. All right, so I'll give you an example. Let's say if I, over the next 5 years, I make in excess of all of our salaries and everything, an extra 400 grand on a yearly basis. I'm just picking a number out of the sky. Then what we could do is we could not distribute that to my wife and I, keep it inside of the company and just pay the flat 25% rate. Then what we're able to do is move it in between our structures. So if we've got corporate trusts, we could move that over to a property corporate trust and buy another property. And as long as that property doesn't touch our personal name, it never gets hit at the 45% rate. Or we could move it into another corporate trust that goes into, say, commercial property, or because we always keep our corporate trusts separate, or we could have one corporate trust set up for stock investments, for ETFs and index funds. So we could move that money over there and then invest it inside of that corporate trust structure, which also helps us because when we go into stocks and ETFs and index funds, there's a thing called franking credits. Okay, so if I buy Commonwealth Bank and they give me a dividend which is 100% fully franked, okay, that means that the company tax has been paid at the 30% level. So when they issue the income, if that income goes inside of the corporate trust, okay, it means that I don't need to pay any additional tax, and then that's all of my money, and then I can either reinvest it using a dividend reinvestment plan or put it into something else. But if that went into a personal account, it would get hit at 45%. 30% is being taxed, and then I would have an additional 15% to pay that year because it's hitting my personal name. All right, so these are kind of the things that we've got to talk about. So a lot of people, when they've got these kind of things, especially if they're running profitable companies, and this is something that Maria and I are doing, and everything is legitimate through our accountant, and we always ask what is right, what is wrong, and making sure that we're staying within the confines of the system. And making sure that, if we are saying that Maria is working in the business, that she actually does work, and we have her role and what she does inside of the business. So if we ever get audited, that everything is above board, okay, because you don't want to be saying someone's working and they're not, okay, you do not want to be doing that. All right, so up until now, a lot of people would make the salaries of the husband and wife at 120 and 120. Why is that? Because once you go over that level, you're over the 32% bracket. So trust is at 30 and the company's at 25 now. So if you go into the 37% bracket, you're getting an extra 7 and a bit % tax. Why would you do that? You might as well keep the money inside of the company and pay retained profits tax. Okay. Also, you get other benefits with holding things long term. So I'll give you an example. If we distribute money into our personal name, a portion through salaries, and then we keep a portion in the company as retained earnings inside of the bucket company, we could either keep that in the company and reinvest in the company, or we could move it inside of our trust structures. We could do it that way and invest in shares, commercial property syndicates, a lot of different things that we could do. All right, and yeah, you're in a position where hopefully you're putting that income into something that you never sell. Because if you never sell that asset and you build wealth long term, you're not paying capital gains tax on property, on stocks, ETFs, index funds, those kind of things. So if you hold it for life, you're not paying capital gains tax or CGT. So your balances keep on going up, and your goal is to get as much asset base as possible that compounds over your life. So a lot of people, when they look at the tax system, they try and save as much tax up front, and I get that. They don't want to pay a whole lot of tax. But what you really need to do is layer yourself so the majority of your income's at the 30% level, which is what we do personally, and then you distribute as much income into that as possible up to that level, and then you want to put that into an asset base that you never sell, and then over the years you're constantly getting more and more asset base that's going up on a yearly basis in 2, 3 or 4 or 5 different asset classes. And if it's going up tax free and you never sell it, then you're not paying tax on that. So that's how you really build, lifetime wealth. So this is just us talking about what we're doing. I mean, at the moment we've got at least 2 or 3 companies, probably 3 to 5 corporate trusts, and everything is run and mapped out through our accountant. All of our properties have their own offset account linked to it with a separate trust account linked to it, so everything's aligned and everything is linked up to accounting software, and my wife's got an accounting background as well, which does help us keep track of everything. Okay, so always making sure that everything's linked up and itemized so you know what's personal, what's not, and not cross-purposing accounts, because the bigger you get, the more systemized you need to be. Stop pulling everything together in one account. Keep everything separated. Yes, it does mean that you've got a lot of different accounts to maintain at multiple banks, but come tax time and the accountant and audits, it's so much better, and everything's itemized through accounting software, so they can never say that, where is your receipt or things like that, even though we do keep receipts on a yearly basis in a container, but really with how we've structured it, these kind of increases in the tax brackets is going to impact a lot of people. So yeah, that's from the business point of view, but this is going to impact a lot of salary workers and PAYG workers as well. So those people are going to be on a 30% flat rate. So a lot of people are going to increase their lifestyle based on that, extra benefit that they got on the tax breaks, when really they should be investing the difference. So we're very big advocates of buying property first, and you can get up to a 5 or 6 multiple if you have a 20 or 10% deposit on property, and get yourself up to a point where you've replaced your income, which is what Maria and I have done and a lot of our clients want to do, and then you can do whatever you want after that. All right, so if you need help on the investment finance side, or you need help with buyer's agency or finding property or building out a sequence of buying property to replace your income and build your wealth, we do that as well. We have a very good strategic partnership which we've taken a long time vetting and finding. So if you need help on that front, hit that subscribe button, hit the comment, hit the like button, and if you want to book an appointment, down below in the description box you can do that. All right, hope that this video has given you a lot of value, and we will see you on the next one. Have a great day. Bye.